Now, IAS 12 is about taxation, income taxation. Of course, every entity is meant to pay tax. Now, what I'm going to do is to make it simple for you, not make it any more complicated as it should, but to make it very simple. What you need to know is that whenever we are dealing with income taxation, there are two aspects of it. The first aspect talks about the current tax. All right, that is the one that is going to your P&L. And we have what we call a deferred tax. Deferred tax is actually an accounting adjustment on transaction, all right? So it's not really something that happens in reality, but it's just an accounting adjustment, all right? So in Ghana, for example, our tax laws doesn't give any recognition to deferred tax because it's just an accounting adjustment. Now, what you need to know for your exams and practice is that when it comes to the current tax, there are three things that comprises of the current tax, and I want you to listen carefully. Number one, you need the entity's provision, all right, or we call it the accountant's provision. So the accountant or the entity's provision. You can also call it estimate, all right? So estimate or provision, whichever one that you want to put is the same thing. For the current year. For the current year. So you need that. You need that. And let me tell you the truth. This thing will always be found in your footnotes. It can also be found in the trial balance, but the footnote will tell you, will give a point to it, that what you see in your trial balance is the accountant provision or whatever. But normally it is found in your footnotes. So please take note of that. And that figure that you'll be giving also will go to your current liability. Please take keen attention to that, to go to your current liability. Now, the next thing you are supposed to also look out for is what we call under or over provision for the previous year. For the previous year. Now, why do we get under or over provision? Remember, tax is paid in arrears. If you prepare an account for 2022, the tax on 2022 account will be paid when? 2023. So normally you put a figure in your account that this is the estimate of tax that you want to pay. In fact, in respective to our Ghana law, even at the beginning of the year, you will do a self-assessment and you will divide your tax payable into quarterly basis, and you'll be paying on quarterly installment. Now, aside that, what you need to know is that that payment that you are making is based on your estimate. It's not a real, you see, it's an estimate that you provided for and you are paying. It is not the real thing you are actually meant to pay. So you see that at the end of the year, it's either you've paid more of the real one that you were supposed to pay, or you've paid less of the real one that you were supposed to pay, or the actual one you were supposed to pay. Now, if you estimated for 2,000, and at the end of the day, the tax man comes and says that you actually meant to pay for 3,000, then it means you underpaid, and therefore you need to pay what? An extra what? 1,000 to it. So that is what brings about the over and the under adjustment. All right. But so if it is an under, then you add. If it is an over, you subtract. All right. And please, where will you see this? You always see this in your trial balance. All right. And sometimes too in the footnote. Okay. Sometimes in the footnote. But normally you will see it in the trial balance. Now, in your trial balance, if it is at the debit side, it is an under. If it's at the credit side, it is over. All right. So please, so the question may tell you or may not tell you. The moment you see the position of the thing in the trial balance, that should tell you that it is an under provision or over provision. So please, debit side under, credit side over. Take note of that. Then the last thing you need to make up your current tax in your P&L is what we call movement in deferred tax. Movement in deferred tax. The movement can be positive or negative. So take note of that. Now, how do you find movement in deferred tax? That is where you need to go here. Now, when you find the movement, you find it, whatever you get here, the total is what is going to your SPL as tax. All right, so please take note of that. How do we do movement in deferred tax? You need the deferred tax, the opening balance of deferred tax. Opening balance. All right, the opening balance brought down of the deferred tax. You will need it. And also, that is always given to you in the question. So you may find it in the trial balance or you may find it in the footnote. All right, so please take note of that. Then you are, and please bear in mind that there is always an opening deferred tax. If you don't see it in the question, then it means what? It is zero. All right, if you don't see it, it is there, but it's zero. It's just that we don't record zero figures. So you put it there as zero. All right. Then you find your closing balance, deferred tax closing. Now, this is where you need to be careful because we are going to do it now. So you will need your tax rate multiplied by your temporary difference. All right. Plus any revaluation surplus. Okay. So you find it. You find it. That's how you find it. So, and please, whatever answer you get, make sure, understand that this thing can be positive or negative. Understand. If it is positive like this, it will go to your NCL. If it is negative like that, it will go to your NCA. All right, non-current asset. Take note of that. Now, how do you find temporary difference? How do you do deferred taxation calculation for this closing one? Now, what you will be doing is to understand the fact that deferred tax, which I will say DT, deferred tax, DT, is equal to the tax rate, all right, tax rate, TR, okay, tax rate, TR, which is always a percentage rate, multiplied by your temporary difference, TD, all right, TD. Now, how do you find TD? TD is the difference between the carrying amount of an asset minus the tax base, all right? How do you find carrying amount? I hope by now everybody knows carrying amount. You find carrying amount by getting the costs of the asset less what? Accumulated depreciation or any accumulated amortization. That is how you find carrying amount. How do you find TB, tax base? You see, it's the same meaning to carrying amount. So that one too, you need your cost. But you see, the reason why we are doing all these deferred taxation thing is because of the fact that, you see, the tax man doesn't really take into account your depreciation. What the tax man takes into account is what we call capital allowance. So if he lesses his accumulated capital allowance, what he will get is what we call what? The tax base. So this is what we call tax base. And to the accountant, this is what you call what? The carrying amount. So you see, because of the disparity between the depreciation computation and the capital allowance computation, that brings about what we call a temporary difference, a temporary difference. There is another one called permanent difference. What is the permanent difference? You see, if you have done tax before, you realize that in taxation, there is something called disallowable expenses. In the company's account, they will be preparing the account with some expenses. All right, they will be doing that. But when it comes to the taxman, he will disallow those things for tax purposes. And those disallowance are what we call permanent difference because there is no way it can augment itself anywhere. But the depreciation, of course, yeah, if you have IT equipment, you will depreciate it in your office like for 4 years, like 25%. But the tax man, it is 40%. Yes, capital allowance is 40%. So that differences between the rates is what causes you to actually have that kind of temporary differences. Okay. At your level, you are only examining on temporary differences on PP. But when it comes to the final level, we will add share-based payment to it. All right. So basically, this is what you are supposed to know. Now, watch this. You see, what we've done here is to use carrying amount. But what I've added here is instances where the asset has been revalued. All right. Because if it has been revalued, then it means we need to use the revaluation amount. But if you still want to go ahead and use the carrying amount, then don't forget to add your revaluation surplus. Okay. But if you use the revaluation amount to determine your temporary difference, then that's fine. You don't need to add the revaluation surplus again. But if you use the carrying amount, then please don't forget to add the revaluation surplus. Now, once you are done with that, you realize that you obtain some difference. So between here and here is a difference. And that is what we call what? The movement in deferred tax. Now, the last thing I need to show you is that, you see, I've already showed you when you use the carrying amount, you are okay. But when you use the revalued amount, you do well know that revaluation surplus doesn't go to P&L, right? Revaluation surplus goes to OCI. So if the revaluation surplus was included here before you had this figure, and it has also be consumed in terms of determining the difference that you have here. If you put all the figure here as your differences or your movement in DT, you are bringing there an OCI item, which shouldn't be. And so therefore, whenever there is revaluation of that asset, you need to split this one. You need to be able to split this figure into two. One, the OCI aspect, then the balance, the SPL aspect. And therefore, you are able to pick the SPL aspect only to the computation here on your movement in deferred tax. So how do you find the OCI aspect? You do the tax rate times the revaluation surplus. Yes, somebody wants to ask a question?
Please, can you explain again what we were talking about, the movement from, I understand it up to when you are using revaluation, you just apply the tax rate as the TD here. And when you're using the carry amount, you add the revaluation surplus to it before you apply the percent.
Yeah, so you got up to that point.
Yeah.
So what I'm saying is that if there was revaluation surplus as part of your computation of this side, then it means that the movement, the difference that you have includes revaluation surplus.
Okay.
Yeah. And so therefore, you also do understand that revaluation surplus is not treated in P&L. It is treated where?
OCI.
OCI. So you cannot bring the entire difference into an SPL determination. You see what the figure that you are bringing here at the end of the day gives you your SPL.
Okay.
So it means you need to split the difference between what should go to the SPL and what should go to the OCI.
Oh, okay.
And so therefore, how do you find the OCI aspect? It's just the percentage multiplied by the revaluation surplus side. And the balance will therefore be the balance will therefore be the one that will go to the SPL. So you take that one to the SPL. All right. Is that okay now? So this is IAS 12. That's it. There's nothing. In fact, I've decided to make it always easy for you to get it. So don't forget, this one should go to current liability. If this is a positive one, don't forget it's supposed to also go to your non-current liability. Don't forget this is the figure going to your SPL. All right. All right. So take note of that. And anytime this one comes, you see that if there was revaluation surplus to normally your OCI will have the revaluation surplus, all right, then the deferred tax on revaluation surplus, this side, all right, will also come in to reduce it. At the end of the day, you see the number of ticks you have. You have tick 1, tick 2, tick 3, tick 4, tick 5. So, and tax is a compulsory standard. Whether you like it or not, it comes every year. You can't avoid it. It comes. All right. So that is the easy way for you to get it. That's the easy way for you to get it. All right. So what we need to do now is actually take some example and deal with it. All right. So let's pick 1 or 2 example and deal with it. We have been asked here to look at the draft financial statement, and there is income tax expense of 850. Over and under, over provision is giving us over. It's over, so you see it as in bracket. Then we have estimated tax due for the current year we are in. Okay. Then we have increase in deferred tax. So that's the movement. Okay. So that's the movement. So that the tax paid is this. That's the extract from our cash flow. And we are asked to explain how deferred tax arise. You remember how deferred tax arise? I explained to you about the fact that the tax man, how he calculates his carrying amount. This is the tax base. It's different from the way the accountant does it. So whilst this side is depreciation, the other side is what? Capital allowance, and it creates a temporary difference. The percentage, the tax rate applied on that temporary difference is what comes about, we call deferred tax. And deferred tax is an accounting adjustment, all right? So that is the definition of it on some financial accounting transactions, all right, in terms of their tax. Now, their tax treatment. So that is what this is, an accounting measure that is used to match the effect of what transactions with the accounting treatment. So it's just an accounting adjustment. All right. So like I told you, at the corporate reporting level, you have it also in terms of share-based payment. Okay, but come on, you are not there yet. So when we get there, we will meet ourselves. All right. And please, you do know this one I put here. Goodwill itself does not give rise to deferred tax because IAS 12 excludes it. So it's a key point you need to know. Goodwill itself does not give rise to deferred tax because IAS 12 specifically excludes it. Now, given what we have here, then they tell us that we are supposed to identify likely reasons why 200,000 deferred tax provision is seen in the year. Explain the likely reasons. But the same reasons that I gave you, the same reason. Another reason is that you see, when you do revaluation surplus, it's a surplus, and the surplus is taxed. Okay, surplus is an income, but you see, you've actually not sold the asset to have that surplus. It's just an accounting terminology. You revalue the thing, you had a surplus, and the taxman is taking you money for something you have not realized. So these are things that give rise to the deferred tax. So the accountant will say that maybe future he will sell the asset, so he's deferring the tax on that revaluation surplus until when he sells the asset. But so long as he has not sold the asset, the thing is a deferred tax. And he's saying that explain what the over provision in the income statements represent. I told you, I explained that one too also to you. I mean, tax is paid in arrears, and you may pay more or less than what the actual tax is. And this is over. Over means that you actually paid more than the actual tax payable was. So basically, that is that. Explain temporary difference is also not an issue. So in this case, this example, what you see in here is that if you want to do your current tax, you have already been given the movement in deferred tax. So the accountant estimate, which will be sitting in your current liability. So the estimate The current year estimate is how much? 700,000, right? So you have your 700. Then you have over provision you were given from previous year, 2014. That one is 50. So it's an over. So then the movement has been given you. Movement in TD, as simple as that. That one is what? 200. So I think that's what you see as the 850 income expense. That's that. That's that. And the fact that you see in here that the tax that they have actually paid is 600. So you see the following year to you will have the same issue of 250 that is underpaid. All right. So that is how it's like. Anyway, you still have some corporate reporting ones from May, financial reporting ones. All right, so let's pick one of them and deal with it. Let's try this. So during the year, we are told that Dan Suman finalized 2019. They finalized their tax and they paid their liability for corporate tax for the year ended 2018. That what they paid was 21 million, but they had previously estimated 25. So they paid 21. The estimate they did was 25. What should that tell you? If they had done 25 and they paid 21, what should that tell you? Yes, what should that tell you?
Over provision.
They made over provision. Okay. So over provision of 4, right?
Mm-hmm.
So they've made an over provision of 4. Now, you see, they finalize means that that is the one they did with the GRA people and they paid 21. So it's an over provision of 4. Now we are told that the director's estimate for that current year estimate is what? 24.5. So it's as easy as that. How would this be treated? All you need to do is to do the accountant provisions for the current year. Estimate for the current year is how much?
24 point.
And where would that one go? Where would that one go? Yes, where would that one go, please? Hello, class.
To go to the current liability.
Okay. Then we have over provision of how much? 4, right? It's over. So it's 4 million. So you have 20.5, right? Where would this one go?
The SPL.
The SPL. All right, so basically that is as simple as that. Your exams is really not difficult. You need to really understand what you are doing. Just take your time and understand the standards bit by bit. It's 4 marks. How many minutes would you think it would take you for you to just do this thing for 4 marks? Come on, be sincere. How many minutes? If you really know what you are about, it shouldn't take you 5 minutes. All right, let's look at the last one, which is also a 3-mark question. They said that the whole DAS account up to 31st August each year. On 31st August 2019, the tax liability in the book showed a debit balance of 17,500 after paying 2018 liability, a debit balance. So the debit, you need to understand what does the debit stand for, over or under. Then you are told that the estimated for the current year is 84. So is this one, so what do you do? This one, the accountant estimate is 84. 500. What would this one be? Over or under?
Under.
And if you know it is under, how many minutes will it take you? How many minutes would this one take you to get your SPS? So you also know that this one is going to current liability. And so what is your total? Here should be 2, here should be 102, right? How many minutes will it take you to do this one to your SPL? It's as easy as that. And these are your past questions. All right. So that is it for income tax. All right. IAS 12.